Hey everyone, welcome back to Corporate Decoder, the place where we decipher corporate filings. Today, we're cracking open Kayne Anderson BDC Inc.'s latest prospectus. It sounds boring, right? Think of it like this. We're about to find out what a company that lends money to other companies is doing, and maybe, just maybe, we'll find a hidden treasure or a pile of corporate paperwork. So what's the deal with Kayne Anderson BDC? Basically, they're registering to sell a whole bunch of their stock, like 12 million shares. That's about 17% of all their stock floating around as of February this year. Big whoop? Well, it could make the stock price jump around more than a toddler after too much sugar. Keep that in mind, because more shares being sold means things could get bumpy. What exactly is Kayne Anderson BDC? They are a business development company, or BDC. Imagine them as a bank. But instead of lending money to you and me, they lend to smaller private companies. They focus on what they call middle market companies, meaning the yearly earnings are generally between $10 and $150 million. Their goal? Make some income now, and hopefully, see those companies grow and make money for the BDC later. Think of it like planting a seed and waiting for the fruit to ripen. They mostly stick to what are called first lien senior secured loans. That's a fancy way of saying they're first in line to get paid back if the company they lent to goes belly up. It is less risky than being last in line. They also dabble in unitranche and split lien loans. These are a little more complicated, but just think of them as different ways to slice the repayment pie, with Kayne Anderson still getting a pretty good slice. Under normal conditions, they aim for at least 90% of their investments to be in those first lien senior secured, unitranche, and split lien loans. They like lending to companies in the United States. Kayne Anderson BDC is externally managed, which means they hire another company, KA Credit Advisors, LLC, to handle the day-to-day running of the business. It's like hiring a property manager instead of dealing with the tenants yourself. They also want to be treated as a regulated investment company, or RIC for tax purposes. Think of it as getting a special tax break for promising to pay out most of their earnings to their shareholders. Now, there are some important risks tied to this stock offering. Because the seller wants to sell so many shares, the price could become unstable. It could even drive down the value of the stock. Basically, big sales can sometimes cause stock prices to stumble. Kayne Anderson uses debt to make even more investments. It is what is called leverage. Basically, they're borrowing money to try and make even more money. It can boost profits, but also boost losses if their investments don't do well. Borrowing means things get bigger, both good and bad. They have to keep a certain ratio of assets to debt, otherwise they can't borrow anymore. Also, to run Kayne Anderson BDC, they need their advisor. That's KA Credit Advisors. If the advisor does not make good investments, things could go downhill. So what does leverage do to returns? Imagine this very simply. If everything goes great, you make way more money. If everything goes bad, you lose way more money. Now, let's dive into what they actually invest in. They are dealing with companies that take out big loans. If the company is leveraged with too much debt, they could lose your investment. It's like a person having too many credit cards. It can get overwhelming. They sometimes invest in unitranche secured loans. These are like a combo of different kinds of debt, all wrapped into one. It can be good, it can be bad. You have to watch each one carefully. They might buy junk bonds. If an investment is rated below investment grade, it has speculative characteristics. Those can lead to loss of your money. A lot of their loans have floating interest rates. While investments with floating interest rates can be less sensitive to interest rate change than fixed-rate securities, they may carry lower yields and may result in a decline in the value of our portfolio. That may also negatively affect the value of the BDC's stock.
Since the company just did its IPO, the market for the stock has been a bit jumpy. The price may be higher than the net value of what the company owns. The market price and liquidity of the market for their shares of common stock may be significantly affected by numerous factors. That price may change based on the value of their investments.
How has the stock performed so far? It is currently trading around $17 or $42 per share. However, the stock has been as high as $16.40 and as low as $15.70. Here's what it costs to run this operation. Keep in mind, the selling shareholder pays any transaction expenses from selling their shares. It is not something the BDC has to handle. Management fees can take a chunk of the earnings. This is on top of the incentive fees that need to be paid. Basically, if the BDC performs well, the advisor gets a bigger cut. If the BDC does not perform, they get a smaller cut. Then there are other expenses such as interest payments and general costs to run the company such as legal fees, compliance fees, accounting fees, employee salaries, and more. Kayne Anderson does take on debt to run their business. Here is the details. The more borrowed, the greater the asset coverage per unit. As of September last year, here's a snapshot of where their money is tied up. They have investments in everything from aerospace and defense to textiles, apparel, and even wireless telecommunication services. The top sectors were trading companies and distributors at 14.6% and food products at 9.7%. The biggest portfolio companies include names like Basel US Acquisition, Fastener Distribution Holdings, and Pre-Sinmac, to name a few. They have 2 debt investments on non-accrual status, meaning those companies are not currently paying the interest payments.
They distributed some dividends that were 40 cents per share to stockholders of record in September and have distributed similar payments in the past. Now, pulling it all together, is Kayne Anderson BDC a good investment? Kayne Anderson BDC is playing in a space where they lend money to private middle market companies. This can be great because these companies might not have access to traditional banks. However, this can be bad as well, as they may not qualify for traditional banks. So, Kayne Anderson is taking on more risk in this area. This also means more due diligence, less access to information, and greater potential to overvalue the loans. KA Credit Advisors is in charge of making sure this BDC is well managed. If KA Credit Advisors cannot perform as advertised, that can be bad. It is a small company that might have some scaling issues in the future. They are also tied to market interest rates. If the rates go up, the portfolio companies may not be able to pay their loans. I think a reasonable target price would be between $16 to $18 per share. The company has a lot of potential, but keep in mind the risks. So, should you invest? It is tough to say, but for now I'm neutral. If you enjoyed this video, please like, subscribe, and comment. We really appreciate it.